What if I told you there's an account sitting in your name right now, with thousands of dollars in it, that you're probably losing money on every single month? I'm not talking about a scam. I'm not talking about a bad investment you made. I'm talking about your superannuation, the account your employer has been quietly putting money into since your very first job, the account that most Australians set up once at age 18 and never look at again. Here's the shocking truth. The average Australian loses over $50,000 over their working life to unnecessarily high super fees and poor investment choices, and most of them have absolutely no idea it's happening. Today I'm going to show you exactly how superannuation works, what's silently draining your balance, and the 3 fixes that could add hundreds of thousands of dollars to your retirement. Let's get into it. Before we get into the fixes, let's make sure we're on the same page about what super actually is. Superannuation is Australia's compulsory retirement savings system. Every time you get paid, your employer is legally required to contribute an extra 11% of your salary directly into a super fund on your behalf. This is called the superannuation guarantee. That money gets invested in financial markets, shares, property, bonds, and it grows over time. The idea is that by the time you retire, you have a substantial nest egg waiting for you. In theory, it's a brilliant system. In practice, most Australians are leaving a staggering amount of money on the table because of 3 silent wealth killers. Silent killer number 1, fees. Every super fund charges fees to manage your money. Some charge a tiny amount, others charge an enormous amount. And because these fees come out of your balance automatically every year, most people never even notice them. Silent killer number 2, the wrong investment option. When you joined your fund, you were likely put into a default investment option. For most funds, that default is a balanced or conservative option. If you're under 45, this is almost certainly costing you hundreds of thousands in long-term returns. Silent killer number 3, multiple accounts. The average Australian has 2.7 super accounts, each one charging its own fees, each one slowly eroding your balance. Let's fix all 3. Fix number 1. Slash your fees. Log into your super account right now. We'll walk through exactly how to do this. And find your annual fee percentage. It's usually listed as a percentage of your balance, or a combination of a percentage plus a flat dollar fee. Here's your benchmark. If you're paying more than 0.6% per year in total fees, you are overpaying. The best super funds in Australia today charge between 0.1 and 0.5%. Now I know that sounds like a small difference, but let me show you what it actually means over a lifetime. Imagine you have a super balance of $100,000. A fund charging 1.5% in fees cost you $1,500 per year. A fund charging 0.2% cost you $200 per year. That's a difference of $1,300 every single year. Over 30 years, with compound growth, that fee difference alone could cost you over $80,000. Not from bad investments, from fees. The solution is simple. Compare your current fund's fees at the government's Your Super Comparison Tool at moneysmart.gov.au. If you find a fund with significantly lower fees and comparable returns, switch. It takes about 15 minutes online. Fix number 2. Switch to high growth. This is the fix that most financial advisors consider the single most impactful change a young Australian can make to their superannuation. When you first signed up for super, you were likely placed in a balanced investment option. Balance sounds good, balance sounds responsible, but for someone in their 20s or 30s, balanced is actually the wrong choice. Here's why. A balanced fund typically holds around 40 to 50% in defensive assets, like bonds and cash. These assets grow slowly but steadily. They're designed to protect your money when you're close to retirement and can't afford big losses. But if you're 30 years old, you won't touch this money for another 35 years. Short-term market drops are completely irrelevant to you. What matters is maximizing long-term growth, and for that you want a high growth or aggressive option which holds 80 to 100% in growth assets like shares. The numbers make this very clear. A balanced option has historically returned around 6 to 7% per year. A high growth option has returned around 8 to 9% per year. On a $100,000 balance over 30 years, that difference adds up to over $200,000. Log into your Superfund portal right now. Go to Investments. Find the option called High Growth, Growth, or Aggressive. Switch to it. If you're under 45, this is almost certainly the right move. Note, if you have a health condition or other circumstances that affect your risk tolerance, speak to a financial advisor before switching. This is general information, not personal advice. Fix number 3, consolidate your accounts. If you've had more than one job in your life, and most people your age have, there's a very good chance you have multiple super accounts sitting across different funds. Each one charging fees, each one quietly taking a bite out of your retirement savings. The fix is to consolidate everything into one account, and it is genuinely one of the easiest financial tasks you will ever do. Here's exactly how. Step 1. Go to myGov.com.au and log in or create an account. Step 2. Link your myGov account to the Australian Taxation Office on the ATO. Step 3. Under the ATO portal, click on Super. Step 4. You'll see every super account ever opened in your name, including ones you'd completely forgotten about. Step 5. Select the accounts you want to consolidate and choose the fund you want to keep. The ATO transfers everything automatically. No forms, no phone calls. The whole process takes 15 to 20 minutes. And every year you delay is another year of fees being charged on accounts you don't even think about. Do this today. Not this weekend. Today. Bonus fix. Salary sacrifice. Once you've fixed your fees, investment option, and consolidated your accounts, there's one more superannuation move worth knowing about. Salary sacrifice. Salary sacrifice means asking your employer to redirect some of your pre-tax salary directly into your super fund. Instead of that money being taxed at your marginal income tax rate, which could be 19, 32, or even 37%, it gets taxed at just 15% inside super. On an extra $5,000 per year of salary sacrifice, someone earning $80,000 saves around $850 in tax immediately, and that money then compounds inside super for decades. The catch is, it's locked inside super until retirement. But if building long-term wealth is your goal, and it should be, salary sacrifice is one of the most powerful tax strategies available to everyday Australians. To set it up, simply email your payroll or HR department and ask to arrange salary sacrifice into super. They handle everything from there. Now the question I know you're asking, which fund should I actually be in? I can't give you personal financial advice and I won't pretend to, but I can tell you what to look for. 4 things matter most when comparing super funds. 1. Long-term net returns after fees. Look at 10-year performance, not just last year. 2. Total fees under 0.6%. 3. A high growth investment option available. 4. An industry fund structure rather than a retail fund. Industry funds are run for members, not for profit. The best starting point for comparison is the government's Your Super Comparison Tool at moneysmart.gov.au. It compares every fund in Australia on fees and performance in one place. Use it. It takes 10 minutes and could change your financial future. Funds like Australian Retirement Trust, Host Plus, and Australian Super have historically ranked strongly on these factors. But do your own research and consider speaking to a financial advisor before switching. Let's recap 3 fixes that could add hundreds of thousands of dollars to your retirement. Fix 1. Check your fees. If you're paying more than 0.6%, switch funds using the EU Super Comparison Tool at moneysmart.gov.au. Fix 2. Switch to high growth. Log into your fund portal. Find the investment options tab and switch to high growth or aggressive if you're under 45. Fix 3. Consolidate. Go to myGov. Link the ATO. Find all your accounts and merge them into one today. These 3 things. 15 minutes each could genuinely change the number in your retirement account by hundreds of thousands of dollars. If this video helped you, hit subscribe, because next week we're breaking down the 50-30-20 budget rule and whether it actually works for Australians in 2026. Spoiler alert. It's more complicated than it looks. Drop your super questions in the comments. I'll see you next week.